Right now, as the market is live, Stride Inc., ticker LRN, is trading at just $70.16 per share. That is not a typo. It is down an almost unbelievable $83.40, a catastrophic one-day collapse of more than 54.3%. And here is the immediate, jarring insight you won't get from a headline. This collapse isn't because the company missed its quarterly numbers. In fact, Stride just reported first-quarter earnings and revenue that beat Wall Street's expectations. The reality is far worse. This 54% implosion, which has vaporized billions in market cap, is happening because, buried beneath those headline beats, Stride's management essentially confessed to a massive, self-inflicted operational failure. They broke their own technology platform, alienated their customers, and in the process may have permanently destroyed their high-growth narrative. On top of that, law firms are now circling, launching investigations into potential securities fraud. This is the absolute definition of the market's expectation versus a brutal reality. Just yesterday, the general belief was that Stride was a solid post-pandemic growth story. It was seen as a key player in the online education and career learning space, a sector with powerful tailwinds. Analysts had buy ratings on the stock. Price targets were floating around the $150, even $167 mark. Investors, whether they were managing their own accounts through platforms like Fidelity Investments or using a Schwab intelligent portfolio, likely saw Stride as a modern education company capturing a structural shift in learning. The expectation was for continued steady enrollment growth and another clean report. What they got was a bombshell. The reality check came not from the Q1 results, which were fine. Revenue up 12.7% to $620.9 million. Adjusted earnings per share up 39% to $1.52. The poison was in the forward-looking guidance. Stride's management team guided full-year revenue to a midpoint of $2.52 billion. The market was expecting $2.67 billion. That isn't a small miss, it's a canyon. They also guided next quarter's revenue well below consensus, and then they had to explain why. CEO James Ryu admitted that a major upgrade to their core technology platform did not go as smoothly as we anticipated. This is corporate speak for "it was a disaster." He went on to say that this poor customer experience led directly to higher withdrawal and lower conversion rates. In plain English, the system that their students and schools rely on became difficult to use, so people are leaving and new customers aren't signing up. This isn't just a minor bug. This operational failure caused Stride to miss out on an estimated 10,000 to 15,000 new enrollments. For a company whose entire valuation is built on the promise of growth, this is a critical failure. Management has effectively transformed Stride from a growth stock into what the market now views as a high-risk turnaround project, all in a single earnings call. They explicitly told investors not to expect the same level of in-year enrollment growth that they've seen in the past. This is a major black eye that gives competitors a wide-open opportunity to steal market share. It forces every single investor, from the large institutions to the self-investing individual using the Robinhood app or SoFi Invest, to completely reevaluate what this company is worth. The market's answer today is A, half. To pour gasoline on this five-alarm fire, the guidance disaster is now amplifying other, darker clouds that were on the horizon. Law firms, including Block & Levitin and Holzer & Holzer, have announced they're formally investigating Stride Inc. for potential securities law violations. These investigations are centered on accusations that the company may have been inflating its enrollment figures, allegations of misconduct and inflating enrollment figures, and prioritization of profit over compliance. These claims, which had been bubbling in the background, now look infinitely more serious. When a company suddenly warns of a massive enrollment shortfall, right as it's being accused of faking its enrollment numbers, the market assumes the worst. This is why we are seeing volume today at over 20 million shares, an exponential increase as institutional holders run for the exits. So what is Stride, the company at the center of this storm? For those who don't know, this company, formerly called K-12, is a major provider of online education technology. It operates in two main segments. The first is general education, which provides online K-12 schooling, essentially a virtual public or private school. This segment just brought in $363 million in the quarter. The second and more exciting segment has been its career learning division. This part focuses on middle and high school students as well as adults, offering programs in high-demand fields like IT, healthcare, and skilled trades. This was the growth engine, and it just posted $277 million in revenue. Its entire model is based on partnering with school districts and selling directly to families who want an alternative to traditional brick-and-mortar education. It's a business that, until today, had a very strong balance sheet, ending the quarter with over $518 million in cash. This cash balance is now its lifeline. Before this crash, if you looked at the institutional ownership reports from June, you'd see nearly 1,000 institutions on the books. Big names like BlackRock and Vanguard were the top holders, which many investors using Fidelity brokerage services would see as a sign of stability. But you could also see signs of change. William Blair Investment Management, for example, had slashed its position by over 52% in the last filing period. One has to assume that after today's conference call, many of those 292 funds that had increased positions are now frantically reassessing. The next round of 13F filings will be absolutely critical to watch. Will they view this as a buying opportunity, or will they dump their shares, believing the business model is fundamentally broken? This is the kind of investment help that professional managers on platforms like Fidelity Wealth Management are paid to figure out. This brings us to the future outlook, and the chasm between the two potential scenarios is massive. The bear case, which is the reality the stock is pricing in today, is that Stride is in a state of crisis. Management has lost credibility. The core product is faulty. Customers are leaving. Competitors are attacking, and lawyers are suing. The growth story is over, and the company will now spend years and tens of millions of dollars just trying to fix its platform and its reputation, all while potentially paying out a massive settlement. The new 52-week low of $70.05 hit today may not be the bottom. The bull case, which feels almost impossible to believe right now, is that this is a colossal, one-time operational fumble by an otherwise healthy company. Management insists that demand remains strong and that they can fix the platform issues within a year. If, and this is a $3 billion if, they can actually do that, and if the fraud allegations prove baseless, then today's price is a staggering discount. The stock is now trading at just 13 times its past earnings. For a self-investing person with a high-risk tolerance, this is the kind of setup that can produce incredible returns. It's the ultimate falling knife problem. Do you try to catch it, or do you wait to see if it hits the floor? Many professional traders on platforms like Interactive Brokers might be looking at option strategies to play the volatility without committing to shares. This is a pivotal moment for Stride. The market was expecting a smooth ride on the online investing superhighway. Instead, the company's own management team just steered the car off a cliff. Now, I want to hear from you. Comment below with what you think. Is this $70 price tag a generational buying opportunity for LRN, or is this a turnaround story you wouldn't touch with a 10-foot pole? To summarize, The expectation for Stride was continued growth, solid execution, and a rising stock price. The reality is that the company beat its quarterly numbers, but then admitted to a core technology failure that has stopped its growth engine cold, torpedoed its guidance, and invited a wave of legal investigations. The market has reacted by cutting the company's value in half. The trust is broken, and the path forward is now incredibly uncertain. This is no longer a simple growth investment. It's a high-stakes gamble on whether management can fix the mess they created.